Let me tell you what the headlines got wrong this week. Silver hit $120 an ounce. Citi puts out a forecast saying 150 within 3 months. Robert Kiyosaki says 200. Robert Maloney says 375. And the mainstream financial press is either ignoring it completely or treating it like it's some kind of speculative fever dream that serious investors shouldn't pay attention to. Here's the reality. Silver just ran 182% in 2025. It's up 65% in the last month alone. And now you've got a major bank, not some newsletter, not some YouTube channel, Citi, saying it's going to 150 in the next 90 days. That's not speculative. That's not fringe. That's a major institution putting their name on a number that would make silver one of the most explosive moves in modern commodity history, and almost nobody is explaining what's actually behind it. I'm recording this right now from Los Angeles, and I want you to comment what day and date you're watching from, because I always love seeing how far these videos travel, and this story is moving faster than almost anything I've tracked. And real quick, if you value calm numbers first breakdowns like this, where we separate signal from noise instead of just reacting to headlines, do me a favor, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here's the claim making the rounds. Silver is going parabolic. Citi says 150 in 3 months. Kiyosaki says 200. Maloney says 375. The gold-silver ratio just hit 47 to 1, which is the tightest it's been in years. And on the surface, it sounds airtight. Big move, big names, big targets. But when you slow it down piece by piece, you realize some of it is solid, some of it is stretched, and some of it is just people taking a handful of true facts and turning it into a guaranteed outcome. That's clean. It's also incomplete. Because the real question isn't whether silver can hit 150. The real question is what has to happen for it to get there, how fast it happens, and whether you'll actually be able to hold through the violence it takes to make that move. So I'm going to break down 3 things. First, what Citi is actually saying in their report and why their number is different from the other forecasts you're hearing. Second, what's driving this move mechanically, not narratively, and why silver moves the way it does. And third, what you actually do if you own silver, if you're thinking about buying silver, or if you're sitting here wondering if these targets are real, or if this is just hype. So let's start with what we can verify. Citi's commodities research team put out a report. $150 per ounce within 3 months. That's their near-term target. Not a bull case. Not a moonshot scenario. Their base case assuming current conditions continue. Now what are those conditions? Industrial demand that's running hotter than supply. Solar panel build-outs. EV production. Grid infrastructure upgrades. Data centers. All of those things consume silver, and they consume it in ways that don't get recycled. It's not like jewelry where you can melt it down and reuse it. It gets used up in tiny amounts across millions of applications, and once it's in a solar panel or a circuit board, it's functionally gone. That's the industrial side, and that demand has been building for years, but it's accelerating right now as we speak because of policy, because of subsidies, because of infrastructure spending that's already allocated. Then you've got the investment side. Silver ETFs have seen inflows. Retail buying is up. Institutions that traditionally wouldn't touch silver are now adding it as part of a broader precious metals allocation because gold is expensive, and silver offers more leverage to the same macro themes. And then you've got the supply side, which is where it gets tight. Silver is mostly a byproduct. It comes out of the ground as a secondary metal when you're mining for copper, zinc, lead. You can't just spin up a silver mine the way you can drill an oil well. It takes years. It takes permits. It takes infrastructure. And right now, primary silver production is not increasing fast enough to meet the demand that's building. So you've got a structural deficit, not a 1-month blip. A deficit that's been running for a while and is getting worse. That's what Citi is modeling. They're not saying silver goes to 150 because of hype. They're saying it goes to 150 because the physical market is tightening and the price has to rise to either ration demand or incentivize more supply. And since you can't incentivize supply quickly, the price has to do the heavy lifting. That's the mechanism. Clean, observable, no magic required. Now, Robert Kiyosaki says 200. Why higher? Because he's modeling a scenario where the dollar loses credibility faster than the consensus expects. He's modeling a world where people flee financial assets and rotate into hard assets, and in that world, silver doesn't just go up, it goes vertical. Is that plausible? Sure, it's possible. Could it fail? Absolutely. If the Fed tightens more than expected, if the dollar strengthens, if risk appetite comes back into equities, Kiyosaki's 200 doesn't happen, or it happens much later. His forecast is conditional. It depends on a specific macro path. It's not a guarantee. It's a scenario. Robert Maloney says 375. That's the gold-silver ratio going back to historical norms in a world where both metals are remonetizing. If gold is at 6,000 and the ratio goes to 16 to 1, which is where it's been historically for long stretches, you get 375 silver. Is that possible? Yes. Is it likely in the next 3 months? No. That's a multi-year move. That's a structural reset. That's not a 3-month forecast. That's a destination, not a timeline. And this is where you have to separate the analysts who are giving you a near-term price target from the analysts who are giving you a philosophical view of where the market is going over the next decade. Both can be true. They're just answering different questions. Here's a question for you. When you see 3 different forecasts, 150, 200, 375, which one do you give the most weight to? The bank, the entrepreneur, or the cycle historian? Drop that in the comments because I read them and I want to know how you're filtering this noise. Now let's talk about the gold-silver ratio because this is where a lot of people get confused. Right now, as I'm recording this, the ratio is around 47 to 1. That means it takes 47 ounces of silver to buy 1 ounce of gold. Historically, that ratio has been much wider and much tighter depending on the cycle. When it's at 80 or 90 to 1, silver is cheap relative to gold. When it's at 40 or below, silver is expensive relative to gold, or gold is cheap relative to silver, depending on how you want to frame it. Right now, 47 is tight. It's not the tightest it's ever been, but it's tight. And when that ratio tightens, it usually means silver is outperforming gold, which is what we're seeing. Silver is more volatile. It's the awkward cousin of gold that shows up to the family event, does something wild, and then disappears for a while. It doesn't glide, it lunges, it takes the stairs up, then tries to jump out the window. So when you see the ratio tightening, that's a signal that silver is in a momentum phase. It doesn't tell you when that momentum ends. It doesn't tell you if it goes to 40, 35, 20. It just tells you that relative to gold, silver is moving faster. And historically, when silver gets into these momentum phases, it can run further than anyone expects and then correct harder than anyone is prepared for. That's the nature of the asset. If you want exposure, keep it sane. Silver doesn't need leverage to be exciting. It will provide the excitement for free. Now here's the skeptical alternative. Could Citi be wrong? Yes. Could silver top out at 130 and then spend 6 months chopping sideways or pulling back? Absolutely. Could we see a scenario where industrial demand slows because of a recession? Investment demand dries up because risk appetite comes back, and silver falls back to 90 or 80? Yes, that's plausible. Here's how it can fail. If the global economy weakens faster than expected, industrial demand for silver falls. If the Fed pivots and strengthens the dollar significantly, precious metals get hit. If equities rip higher and everyone rotates out of commodities and back into tech, silver gets sold. All of those things can happen. And if you're sized too big, if you're leveraged, if you're emotionally attached to a specific price target, those scenarios will hurt. And I'm going to say something that might annoy both sides. Silver can go to 150 and still correct 20% along the way. Those two things can coexist. You can be right about the destination and still get shaken out if you're not prepared for the turbulence. A correlation is not a contract. Just because silver is up 65% in a month doesn't mean it keeps going up in a straight line. The best moves, the ones that actually make people money, those moves are violent. They shake people out. They make you question the thesis. And then they rip higher after you sold. That's how markets work. That's not a flaw. That's the design. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Silver consolidates here, mid-120s, for a couple of weeks. Profit taking. Momentum cools. The headlines quiet down. Retail loses interest. Then, sometime in the next 60 to 90 days, you get a catalyst. Could be a supply disruption. Could be a major institution announcing a silver allocation. Could be an infrastructure bill that accelerates solar and EV buildouts, and silver rips again. 140, 150, maybe higher. That's within the set of things this market is capable of doing. Path 2. Silver doesn't consolidate. It just keeps grinding. 130, 135, 140, 145. Steady bid. No big pullbacks. Industrial buyers are panicking because they need physical metal and the premiums are blowing out. Investment buyers are chasing because they don't want to miss it. And by the time it hits 150, the momentum is so strong that it overshoots to 170 or 180 before it finally exhausts. That's also plausible. Both worlds can be true in different timelines. I'm not predicting it. I'm saying both fit the structure we're seeing right now. Here's what to watch. First, physical premiums. If you're seeing premiums on silver coins, bars, rounds, if those premiums start spiking above 10 or 15% over spot, that's a signal that the physical market is tighter than the paper market is pricing in. That's bullish. If premiums compress, if you can buy silver at spot or close to it, that means there's no physical stress. Second, watch industrial buying patterns. If you start seeing news that solar companies or EV manufacturers are securing multi-year silver supply contracts at elevated prices, that tells you the industrial side is real and it's not slowing. Third, watch the ETF flows. If silver ETFs are seeing consistent inflows week after week, that's confirmation that institutional money is coming in. If those flows reverse, that's a warning. And fourth, watch the gold-silver ratio. If it keeps tightening, if it goes to 40, 35, 30, that means silver is still outperforming and the momentum trade is intact. If it starts widening again, that's a sign that silver is losing steam relative to gold. Now here's the uncomfortable truth. If you're not already in silver, or if you've been waiting for a pullback that feels safe, you might not get it. You might get a dip to 110 or 115, and that might not feel like enough of a discount. And then it rips to 140, and you're watching. That's the risk of waiting. The other risk, the one that actually destroys accounts, is that you buy at 125, it drops to 105, and you panic sell right before it goes to 160. Not because the thesis was wrong, because you weren't prepared emotionally for the move. And this is why position sizing is everything. This is why having a plan before you enter is everything. You don't just chase a Citi forecast and hope it works out. So what do you actually do with this information? Here's a simple action plan. No drama. Step 1. Decide your maximum allocation first. Write it down. If silver goes to 150 and you have zero exposure, how are you going to feel? If silver drops to 90 and you're all in, how are you going to feel? That's your sizing guide, not the forecast. Your emotional tolerance. Step 2. If you're already in and you're up big, take some off. Not all, some. If your position doubled, consider trimming half. Lock in the original bet. Let the rest run. That way, if it corrects, you're fine. If it rips higher, you're still in the game. Step 3. Don't use leverage. Don't trade silver futures unless you know exactly what you're doing and you have the risk controls in place. Silver moves fast. It can gap. It can liquidate you on a normal pullback even if the long-term thesis is correct. Step 4. The best time to buy isn't when you're reading a headline that says 150 in 3 months. The best time to buy is when you can still think clearly. If your heart is racing right now, that's probably not the moment to go all in. That's the moment to slow down, write your plan, and execute it piece by piece. Now here are my questions for you. Do you think Citi's 150 target is conservative, aggressive, or just right? And which forecast do you actually believe? The bank's, Kiyosaki's, or Maloney's? Drop your answer below and remember to include what day and date you're watching from. If you got value out of this, subscribe and comment FinTalk OG so I know you want to follow up when these targets get updated or when silver makes its next big move. And if this helped you, share it with someone who's confused by all these different numbers and trying to figure out what's real. All right, take care of yourself, and I'll talk to you soon. And just so we're crystal clear, this is educational commentary. It's my take based on publicly discussed information and my own reasoning, and it's not personal financial advice. I'm not your advisor. I don't know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation. And if you need personal advice, get it from a qualified professional who knows your situation.